Please use the microphone.
Oh, yes, I will. Pardon me. Turn that on. Okay. Right. Here we go. Okay. This statement on screen is something I think most people in the room are familiar with, but it was very hard for me to convince non-economists that this was true, because you need to do an economics degree to learn that economists don't know anything about banks, debt and money. And part of the reason why they do that is they use this argument because assets equals liabilities, you can ignore the level of debt. It's simply a transfer between social groups. It doesn't matter. So this is Ben Bernanke back in his essays on the Great Depression, explaining why nobody in neoclassical economics took Irving Fisher's argument about debt deflation seriously. And notice the logic here, and it was wonderful this stuff could now be shown for the fallacy it is. It says it's no more than a redistribution from one group debtors to another group creditors. You can instantly see that's, of course, ignoring the fact that some debtors go bankrupt and therefore can't pay the creditors, so there's a net sum loss with bankruptcy. But apart from that, the argument was only if there are huge differences in the spending propensity of the two groups could the macroeconomy be affected by changes in the level of debt. And this is more recently Krugman in his End This Depression Now, and also his blog, saying if you look at the overall level of debt makes no difference to aggregate net worth. So assets equal liabilities, you can forget about it. One person's liability, another person's asset. Notice it's persons, not bank, non-bank. He said, therefore, debt only matters if the distribution of net worth matters. That's all that is important. Again, back to the slightly more sophisticated version of what Bernanke was arguing. Now, this gives them what you can call a loanable funds model of banking. And Krugman used this in his argument with me on the blog earlier this year. And this is why I have to send him a Christmas present for this particular statement, because it solves me having to, persuade people that they don't include banks, debt and money when the Nobel Prize winning so-called macroeconomist makes a statement like that. Why is it so crucial to talk about debt and leverage? And he said, well, I said it's because once you include it, lending increases the money supply. Now notice the next thing. Okay, but why does that matter? And he says, I then go to assert that lending is by definition an addition to aggregate demand, which is correct. He said he doesn't get that at all. And his reason for not getting it is this proposition. If I decide to cut back on my spending and stash the funds in a bank, which lends them out to someone else, that doesn't have to represent a net increase in demand. In other words, my capacity to spend goes down because my funds have been transferred to another person. The other person has more spending power. The two balance each other out, and in the aggregate, there's no impact. Now, I normally go through and deconstruct this and show academic arguments and arguments by central bankers that show why it's wrong. But I want to start basically treating them as neoclassical's naive children now, and giving the adult version first and explaining the children version later. So if you look at the real world, what actually goes on is bank lending. And the argument that Graziani gave us in circuit theory, I think, is one of the most important contributions to Post Keynesian economics ever, was to argue that what money really is the liabilities of the banking sector for the rest of the economy. Therefore, if you have an equal increase in the assets and liabilities of the banking sector, you actually have an increase in the amount of money in circulation. And when that money is first put into circulation, it increases demand. People borrow money to spend it. Now, there's lots of mathematics behind this that I won't go into, but I have elsewhere to show that you can then aggregate this at the systemic social level and argue that aggregate demand or effective demand in the economy is the sum of income plus the change in debt. Now, I know a lot of post-Keynesians think I'm double counting on that. I'm still trying to persuade them of the mathematics. But it is academically, mathematically correct to say that at the aggregate level. So the genuine adult reality of lending is pretty much this model, which is that it's not lending from person to person, it's lending from a bank to a person. And Schumpeter gives us the best overall position on this. I think Schumpeter's theory of economic development, again, is another very essential reading for a non-neoclassical approach to economics. And the argument goes that an entrepreneur approaches a bank for a loan, and the bank effectively says, yes, that's a good idea. We think, here's $1 million, and by the way, you owe us $1 million. So simultaneous creation of the asset and the liability is the fundamental background process that enables money to be created and expanded. So that you grant the loan, you create a deposit at the same time, and that puts additional spending power into circulation that wouldn't have existed without the bank loan. So demand therefore exceeds demand from income alone, which is written heavily through Schumpeter and Minsky and so on. Now what I want to do is illustrate that with a software package that I've been having developed with an INET grant, which I'm currently calling Minsky. And what it lets us do is build a mathematical model of the financial and physical flows using a double entry bookkeeping table. Now I know that's very hard to see on screen there, unfortunately, but let's just go through what the components are. This is a double entry view from a bank's point of view of what's involved in lending. So each of these columns, this column here is loans by the banking sector. This is the bank reserves, which conventional theory teaches students that banks lend from reserves, which actually is, in accounting sense, impossible, unless they can lend from borrowed reserves, not deposited reserves. I'll go through that later. And then I have what's called a patient agent, because what Krugman and neoclassical bankers say, and that's why I say it's a child's version of banking. They talk about patient agents lending to impatient agents, not banks lending to corporations, which is the real world vision of what actually happens. But I put the patient agent inside there. So these two things, the loans and reserves, are both assets of the banking sector. The following columns are liabilities, deposits of the public in the banking sector, and the final is the bank's equity. And lending is an increase in the level of loans outstanding for the banking sector, matched by an increase which is shown as negative because you're looking at it from the bank's point of view. The increase in money is an increase in its liabilities. A minus over here for the lending to the firm sector. Then the firm sector pays interest to the banking sector. The firm sector hires workers by paying wages to the workers. The bankers then consume, the workers then consume, and finally the firm sector repays the loan. Now that's a very stylized version of the Post Keynesian vision of lending. And when you simulate this model, what I now have over here is lending being related to the level of outstanding loans already, so loans grow double on a 7-year basis. You pay interest on the loans based on the rate of interest on loans. Workers' payments are equivalent to workers' share of GDP. Workers consume based on their bank accounts, and because they have a small amount of money, they turn over their bank accounts 26 times a year, effectively. So they're spending on a fortnightly basis, and I have wealthier bankers spending on the basis of turning over their accounts once a year. Much richer, much smaller number. So I simulate this model, and what I want to show you now is what happens to GDP. And GDP grows over time. Okay, I'll just actually, that flashing there, pardon me, a little bug we've addressed in the most recent version, but I haven't yet got that installed. When I have that table in the background, that's what causes the flashing. So you get exponential growth in GDP over time, which is what we've seen. Okay. With, of course, this is a very stylized model, so I have no crises going on there, etc., etc. In a more advanced model, of course, I have crises. So that's illustrating conventional real banking in a very stylized way from the macroeconomic point of view. And that's the model embedded there. Now, the neoclassical model is this idea of a patient agent lending to an impatient agent. Here's a patient agent with lots of money and an impatient agent with none. And the patient agent transfers money across to the impatient agent. And that means, of course, that the patient's spending power declines, the impatient agent's rises. In the aggregate, there'll be only a tiny change depending on whether one's propensity to spend exceeds the other. In aggregate demand, you can ignore banks. That's the conventional thinking. And what that really means, neoclassicals don't have a model of banking at all. They don't include banking. Even Krugman's most recent paper, where he tries to model debt, doesn't have banks and doesn't have money, because what people lend to each other are bonds denominated in the consumption good. Okay? And that's probably the most advanced piece of work in neoclassical modeling, with the exception of the recent IMF paper by Kumov. It's a different kettle of fish, a much more intelligent piece of work. But when I put that together in this program, and this is why they argue you don't need to worry about the level of lending. So what I've got now, to show you that table again, notice there's nothing happening on the loans on the asset side of the banking sector at all, because the bank's not involved, just an intermediary. And what is actually happening is the patient agent lends to the firm sector, which is my impatient agent, and then there's nothing happening from the safe of the bank sector either, and the consumption by the patient agent of goods produced by the firm sector and so on, and you repay the patient, the firm sector repays the patient agent over time. So I simulate that model. Oh great. Pardon me. Somehow a wire got deleted there, and I don't know why. This is one of the things when you're working with new software and rewriting it. Let's see if I can get the wire to work from here. Yes, hooray. Okay. Oh, because we're still running, that was the problem. Okay. GDP flatlines. Okay. And if I change the rates of lending and stuff like that, I make a trivial difference to where the GDP actually flatlines. So from their point of view, you don't need to worry about banks, debt and money. It's the mental model they've got of banking, which is why they don't understand it.
So can you just rephrase a very, very simple language, why debt flatlines, GDP flatlines? What's the difference?
Yeah, well, the difference here is there's no creation of additional money going on. All you've got happening is a transfer of money from the patient agent to the inpatient agent. And then it only depends upon, the only impact that'll have on the macroeconomy is whether the patient agent spends more rapidly than the inpatient agent.
And that's the model that you just shown.
Yeah. With, again, as I can see there on screen, I have to show this to Russell, a couple of bugs turning up in where the display is made in the table, but the mathematics is still correct. So what you get is only a trivial impact. If the firm sector spends more rapidly than the patient agent does, then there'll be a tiny boost to GDP out of the difference. So if I played with the lending parameters, I could make a tiny change to GDP, but pretty much enough to ignore. So that's the
neoclassical model.
That's the neoclassical model. Real world being totally different. So that's showing the whole perspective of the neoclassical vision. Now, Minsky, decades ago, realized that vision, that level of debt didn't matter, had to be wrong. But at the same time, you have the aggregate recording identity that recorded income equals recorded expenditure. So he went through trying to reconcile this, but as part of it, I want to show you what the importance of seeing the role of rising debt in driving aggregate demand. He said for aggregate demand to be increasing over time, then current spending plans have to be greater than current received income. And there has to be some tech method by which you still reconcile this at the accounting level with financial flows. So it follows, therefore, that some sectors, when growth is going on, finance their spending by emitting debt. And therefore, for that to happen, it has to happen in such a way that the increased spending financed by the debt is not offset by reductions in the spending plans of other units. And that's where endogenous money comes in. The capacity of the banking sector to create money by double entry bookkeeping adds to the monetary demand in the economy and then enables growth to occur and also increases the level of debt outstanding. So effective demand is income plus the change in debt. Now, with that together, you can now understand where the crisis came from. Because if you look at the decline in income, it certainly was there. Nominal GDP fell, but nothing like as great as the Great Depression. And yet when the crisis first hit, everybody's feeling was this is another Great Depression. And the scale of reaction the government sector had, in particular in America or all over the world, was huge. So let's just take a look at it from the point of view of the aggregate level of public debt, the aggregate level of GDP, and the aggregate level of private debt. And notice this is public debt. That's what all the politicians are obsessed about reducing and controlling. That is private debt. So even with in some time in the next 6 months to a year, at the current rate of growth of government debt, it will exceed GDP. And that's what's framing the political debate in America right now. But you notice what happened with private debt, growing exponentially, then reaching a peak and then falling, and then flatlining for the last 2 years, pretty much. Now, what I want to now do is to take that same data and put it in the sense of aggregate demand plus the change in debt. So when you take a look at now looking at GDP and the changes in debt over time, and now you can see there's the downturn in GDP starting about a year after the crisis began, with the BNP shutting down its funds that were exposed to the subprime market in America. But notice shortly after that BNP event occurred, the rate of change of debt went from being plus $4 trillion per annum in a $14 trillion economy down over the next 2 years to minus $3 trillion. So there's $7 trillion turnaround in aggregate demand. Now that's huge, far bigger than the little dip in GDP up here. And notice public debt starts to rise about a year after the crisis. So what neoclassical economists supported the politicians obsessing about, the level of public debt, is a response to what's happened with private debt, not a causal factor, though it can be made into one by bad policy. Now, what I'm now doing is putting together those components by showing you GDP, then GDP plus a change in private debt, and then GDP plus a change in both private and public debt. So the black line is GDP alone, the red line is GDP plus the change in private debt, and the blue line is GDP plus the change in both private and public debt. And now you can see the severity of the crisis, why it was so extreme and so rapid. The peak in total demand in the economy, roughly $18.5 trillion in private debt terms, the private economy, occurred just after the BNP decision. Then it plunged from $18.5 trillion roughly to $11.5 trillion, which is huge. 38–40% drop in demand, which hit, of course, both goods and services markets and also asset markets. Now, when you add in the government spending, this gap here is the scale of government spending at the time, debt finance spending, about $500 billion. By the time we get to this level, it's grown to $1.5 trillion. So the consequence of that is that rather than being a fall from an $18.5 trillion to an $11.5 trillion economy, you've gone from about $19 trillion to about $13 trillion, 12.5, $13 trillion. So it's cushioned the blow of the downturn. And this period here is because of the rate of the decline of private debt stopping and then going flat line. So as time goes on, there's no change in the level of private debt, and therefore you're getting no contribution to demand from rising private debt, but you're still getting about a $1 trillion boost to effective demand from government spending. Now, what I'm considering would happen with the fiscal cliff when if that actually comes to pass in just over, literally a month's time, that $500 billion drop that would then occur in government spending will also probably trigger renewed deleveraging by the private sector. So you'll have private debt falling at the same time as public debt is falling, so there'll be two forces taking demand out of the American economy. And therefore, if they do go through the fiscal cliff, they like to renew the process of falling back into a depression again. And I regard this as a lesser depression simply because of the scale of government spending. Now, I want to now show you why the change in debt is important, because again, it's so hard to get this through to economists. The public, generally speaking, has a better understanding of the role of debt than neoclassical economists do by an enormous margin, and even a lot of non-conventional economists. This is correlating the change in private debt as percentage of GDP to the unemployment rate. And to make it easy to see the correlation, I've turned the unemployment rate upside down, so I'm starting from 0% unemployment here to 12% there. Now again, according to the neoclassicals, there should be no correlation between these two series until we hit the zero lower bound, as they call it, when reserve rates fall to zero. And then at that point, Krugman makes the liquidity trap argument and argues that the level of debt does matter then, but not beforehand. Well, if the level of debt didn't matter, the correlation between those two series should be roughly zero. It's roughly minus 0.92 over a 20 plus year period. So you can really show the causal impact of change in debt on the level of aggregate economic activity. It also applies to asset markets. Because I went ahead of myself there, pardon me. Because I argue that effective demand is income plus the change in debt, then it means the change in effective demand, which drives whether the economy rises or falls, is the change in income plus the acceleration of debt. So acceleration of debt, the second differential in respect to time effectively, has a driving force on the rate of change of economic variables such as the level of employment. And I'm graphing private employment here. Now, frankly, I didn't expect the economic data would support that proposition, because economic data is so chunky and so badly organized compared to science data. I just didn't think I'd find I could find a decent correlation between a second order differential and a first order. But I didn't explore it, and a couple of economists working for Deutsche Bank did, Biggs, Meyer and Peck. And I then was persuaded to take a look at it, and the correlations blew me away. This is over a 55-year period, and the correlation between the acceleration of debt and the change in employment is 0.76. So again, you don't get correlation like that on you unless you were talking a causal force over that period of time. And then again in asset markets now, this is looking at the acceleration of mortgage debt and the change in house prices in America. The correlation there is 0.83. So again, acceleration mortgage debt is what drives change in house prices. And finally, I couldn't find American data, but I could find Australian data on the relationship between acceleration of margin debt and change in the stock market index over on a yearly basis in Australia. Again, correlation 0.8. So you have overwhelming empirical and sound theoretical arguments that change in debt drives economic activity. And when you have a Ponzi scheme like we've been through for the last 30 years, you have a debt finance system which has to break down, which is what we're going through right now. So there's a desperate need to control the level of debt and not let debt finance speculative activity, but restrict it to financing investment and necessary consumption. And neoclassicals will never see this. So they ignore money and they treat debt as a zero-sum game, and their mental picture is Say's law. Now, what I've argued, you actually generalize Say's law. Say's law would be true in a commodity-only economy where there were no capitalists. It's a model of capitalism without capitalists. When you include capitalists and you include banks, the general law is this change in there's still an accounting identity, which is what they saw Say's law as being, but it's now an accounting identity, including the capacity of the banking sector to create new money and to create additional demand in the process. So those are, yeah.
Remind people what Say's law is. I'm not sure everyone knows.
Oh, who doesn't know what Say's law is? I think it'd be fairly, the idea of the supply is demand. Fundamentally, the proposition that what you sell becomes demand. Okay, so the Say's law vision says that you have to sell something before you can buy. Whereas the perspective from, and then what you sell becomes demand, therefore there can never be what they call insufficient aggregate demand. If there's an imbalance between different sectors, so the price is too high compared to equilibrium in one market, there'll be insufficient demand there, but there must be excess supply somewhere else to balance that all out. Whereas when you do the accounting identity, if you have the banking sector not expanding the money supply, actually withdrawing money, then you can have what they say is impossible, which is an aggregate glut, what they would call a glut, or insufficient aggregate demand to employ all the resources you have. So that's the vision. That's why neoclassicals aren't worth listening to on money, but we have to persuade the rest of the world that's the case and stop them being taken seriously. Thank you.
Thank you. Okay, and the next now is Danny Lang. Please.
Yeah, thank you. I could have made a closed presentation, but here, so because I'm also Post Keynesian, I'm also really concerned about the fact that there is no, they don't take into account the money seriously and